Well, let's start off with, that's helpful background, a little more about, was there a moment in your kind of history process where you decided, and this is more to Ken and Tommy, where the moment you decided finding a partner, selling to private equity was the right next step for you, and kind of what were the key things you were looking for in a partner?
For me, it was COVID. When they told me I couldn't go to work, I was like, screw that. It was Wolf of Wall Street. I stood up in front of the company, a couple hundred employees, and said, they're going to have to bring the cops and yank us off the roof because we ain't stopping. And quietly, behind the scenes, I was like, oh, geez, man, what if they really stop us from working? And so I decided to put us out, reduce SIM, and look for private equity, really to mitigate risk.
You know, COVID was a really good opportunity because the multiples went through the roof. And, you know, the record-setting multiples are 22x of EBITDA. And we were right there. So we got to $27.5 million of EBITDA at the time. And Ken Goodrich called me up with Gettle. And he said, you're a really smart guy, Tommy. He's like one of the best home service guys I've ever met. You can make technicians. You know how to book phone calls. You're super profitable. You know your numbers. Your EBITDA's at a high margin. But you don't know what these guys know. You don't understand financial engineering. You don't understand how to raise capital. He goes, if you knew what they knew on top of your blue-collar background, you'd be, you know, at your age. He goes, my first deal was around 40. You're 39 at the time. He's like, you'd be deadly if you knew what they knew because they need you more than you need them. But when you understand how money works and how to get through a deal and how to build a SIP and understanding the financial engineering behind it and how to use debt properly to hedge your bet to actually get way higher returns, which is crazy what I'm learning. So I basically was like, could I grow faster? Any partner I've ever wanted to take on is going to make me faster growth. It's going to get me to my goal way quicker. And in this case, it did. You know, we're going to do 85 million of EBITDA this year. We sold in 27. This is year 3. So I was better being 50% of something way bigger that would grow faster. And I had a delayed draw term loan for 25 million. That was not enough money because they wanted a 3-month seasoning between deals. So I didn't have enough money to buy the opportunity I had to have been in front of me. And I basically didn't have the skill set. I didn't know the financial engineering.
Excellent. No, it's all. And Chris, what about you? I mean, I know you all have not partnered or sold. It's still closely held within the family. Can you talk about, I'm sure have plenty of opportunities of people that approached you and how you've evaluated those and what has led you to the decision to not take that on at this moment?
Yeah. At first, I'll say there's not a right or wrong path, right? It's a very unique personal answer around what are your priorities, what matters to you, what role do you want to play in your business, what knowledge you have or not have to be able to execute on your growth strategy. But as I look at my own journey, right, the last 5 years, I've had bankers tell me there's never a better time to sell than now. And they've said that every year for the last 5 years, right? They're great sales folks. And had I listened to them 5 years ago and sold, what I would have left on the table from an enterprise value perspective would have been tremendous, right? If you're confident in your own ability to execute, put your head down, sustain high organic growth, and or start to be able to acquire and integrate businesses on your own, I think I think getting to scale is sort of worth the delayed gratification, right? Because you look at multiples that for a $1 or $2 million EBITDA business look very different than a $5 million EBITDA business, look very different than a 10 or 15 or 20. And so the longer you can keep betting on yourself and executing on a strategy that gets you to the end of the market where you're going to receive greater value, I think that's better. But again, not a right or wrong answer. And we tend to be pretty selective in our partnerships today. Similarly, we have a $25 million acquisition line. Our net debt today is 0. The folks we started to acquire, we've been really, really thoughtful and selective on what those partnerships look like. And we structure, I mean, heck, what is private equity? I guess we could be called that to some degree when we're acquiring different businesses. They're rolling equity. We've got a cap table at each subsidiary level. So it's been a fun journey, but we're committed to long-term private ownership. The other thing I would say that mattered to me was sometimes in the private equity world, there's a lot of short-term thinking that accompanies that decision-making, right? When you're leading up to the 12 months before a sale, I've seen a lot of folks engage in some value-destroying behaviors and knowingly sacrifice long-term reputation in return for short-term financial gain. Not everybody does that, but you see the incentive sort of push people in that direction. In my world, I don't have to play those games. I'm thinking about value creation over 5 years or 10 years or 20 years, and it leads to a different set of decisions.
Excellent. Thanks, guys. As owners and runners of your business, and I know, Ken, you're retired now, but think about kind of your role when you're back involved day to day. I mean, as the operators of these businesses, a lot of what you do, there are high-stake decisions you are making. how do those decisions change when you have they're influenced by the ownership model you all have? Obviously, the ownership model varies by person, but think about how that ownership model influences who's in the room for those decisions and how the decisions are made, who's got final say, things like that. And we'll start with Ken, and we'll go in some order.
I took a minority share, and so I sold the majority to private equity. And you need to be okay being a good general, but also being a good soldier, because now you have a boss, and it's typically the board. And as long as you're good with under-promising and over-delivering, the board will give you everything you want. And if you have a good relationship, you communicate well, and you execute well, you're gonna be fine. They're just gonna throw money at you and say, hey, do more of it. But if you don't have a good communication cycle, if you run into issues, you're not able to communicate it well. If you make promises and you're not able to deliver, they'll pull the rug out from underneath you. And it could be a negative situation. I had a pretty positive situation. I had pretty positive experience, but it's not always that way.
Tommy?
Yeah, so here's the deal. These guys look at more deals than I could ever dream of. They're looking at 100 deals a week. They know how to go through a financial statement. They got a whole team of advisors that look at how to buy better than you could buy. They're more if they've been around a long time, they've got a really great track record. They've got more connections. They could literally call up the manufacturers. I mean, my PE company's founder is best friends with the largest garage door company's CEO of the subsidiary of the company. And he goes, you're going to sell to them in a much better price, even though I was already the largest volume in the country. So they came to the negotiation table. So I use them strategically, and I really do listen. I am a student, and they are my boss, but they do not interfere. Doug always tells me, we didn't buy A1, we buy you. And you hate to lose, and you're a fierce competitor. And the one question mark he always said is that I was worried about you. And quite frankly, every company at the bidding table was worried is, can we tame the beast of a true entrepreneurial spirit that likes to go do things on the fly? But you slow down. We're very methodical. We're very disciplined. Out of every 100 deals, we might buy one. We bought 12 companies, but we're greenfield and we've expanded dramatically. But it takes a lot of discipline. And this discipline is what I needed in my life. I needed them. And I don't make any money for referrals, and I could be completely transparent with you guys. I did the right deal. I don't have any regrets, and I love where we're going. And I've got great partners that micromanage with me, alongside of me. We don't have a board meeting. We have a monthly powwow for 3 hours. That's it. If we're going to hire anybody for over 200 grand, they want to just give the nod and the thumbs up, but they just let me do my thing until the numbers start going down, which never happened. We've never not had budget, but trust me, if they got to go sit every week, they sit on a board meeting with their partners that invested in them. And when it's not going good, they want to know, what are you going to do? And just as much pressure I have on me, they have 10 times more pressure on them. They're sitting down with pension funds of teachers. And so they got to be able to answer these questions. So I don't feel bad when I got to answer difficult questions, because I know who they got to answer to.
Thank you. And then Chris, I mean, again, different ownership model, but you're still making the same level of decisions. How does your ownership model influence who's in those rooms, how the decisions are made?
Yeah, I would say this is actually one of the great pros about private equity is you've got a partner who's going to demand a high level of accountability. And I think often in family-owned businesses, right, the perception is they're sleepy, they're unsophisticated, they're not high performance. You often hear them use culture as an excuse for why their margins suck, right? And I think the reality, at least on the PE side, is that those excuses don't fly, right? And I think as a family-owned business, we have to think and operate the same way. We want to take the best parts of being able to make decisions as two brothers who own the business, but we also want to incorporate the best parts of a high accountability, PE-like governance structure and PE-like accountability model. So I don't think that changes. And I think if you own a family-owned business, don't let those excuses around culture or whatever it is allow you to accept results that are subpar.
Let me just say this about Chris. He's not your average bear, average owner. He hangs out with private equity. He's at every one of the events. He's super connected. He's friends with, he knows the financial game better than most of the PE companies. So he's not your typical owner like I was. He knows how to structure deals better than anybody I've ever met. So I just don't, I would not go PE or not based on Chris, but he's the most elite I've ever met that hasn't done a PE deal to understand how deal flow works.
Can we hug later?
Yeah, please.
All right, Chris, I got one more for you. 'Cause I think Ken and Tommy have both mentioned the value of having partners around the table that could bring value and bring resources, bring expertise you may not have had and you mentioned discipline as a key component. Are there things, I know you don't have equity partners in your business, are there things that for advisors or mentors, people you call on to get a similar level of insight, feedback, responsiveness to what's going on that are kind of involved to help you work through issues, even though they may not be equity partners in your business? I mean, it's mainly the feedback you're looking for in the thought partner.
100%. I'll answer in two ways. One, I think one of the things that I have done well over the last 8 or 9 years is to recognize when there's people who can do parts of my job, things in my span of care, way better than I can. And I'm very quick to bring those folks on the team, whether we're talking about functional leadership around the people team or marketing or whatever it is. But our board is no different. So I have a board. The difference is my board's not a fiduciary board. It's an advisory board, which means when we get together every quarter, I can listen to what they say and I can say thank you. And I don't have to do it, but it's all just advice. But the way I put together those perspectives on the board is I say, okay, where am I today? Where am I trying to go? What are the knowledge gaps that I have that might prevent me from getting there? Whether it's M&A work, whether it's capital structure work, finance, banking, operations, customer service, technology, and how do I augment my perspectives, the voices in the room, by getting advisors, and they're paid advisors per meeting on my board that come and can provide that perspective. Now, again, it's advisory, but I like that better because then I can have this great, fruitful discussion, and there's none of the formalities that accompany a traditional fiduciary board, but I get all the benefit of advice and perspective. And I put folks on there for 1 or sometimes 2-year terms, and then I cycle them off, and I'm not afraid to say, hey, I needed your perspective when I went from 30 to 60. I need a different perspective as I go from 165 to 400, right? It's a different set of problems and a different set of challenges.
Yep. That makes sense. That makes sense. It's good because look, they mentioned that's a big component. So it's great. You found ways to take the good parts of product you want while also keeping it family owned. Let's talk about growth. What are some ways that partnering may have enabled new ways for you to grow, whether it's hiring, expansion, acquisitions, that they brought new resources to help you accelerate what you may have already wanted to be your own, but weren't able to? Well, Ken, I'll start with you.
Our whole strategy was about acquisitions. It takes far too long to greenfield a location, get a reputation going to make the margins that you need to make. So we can walk into a market, we can buy the biggest player in that market and own it immediately. Plus, once you roll that into the whole organization, all of a sudden, whatever you paid for it comes up to the level of the organization's EBITDA or multiple, however you want to look at it. And it just makes everyone more valuable. So for us, it was an acquisition strategy. The only headache was trying to get some people who have been in the market for a long time, who have, this is the way we've always done it, onto a system that's proven that works better than theirs. Sometimes it's a little bit of a rub, but if you can get past that and you get buy-in, it's a win-win.
Tommy, we'll go to
Yeah, well, I'll tell you this, buy and build is great. It doesn't really always work that way. Garage stores, you got commercial, residential, you got the box stores, you got, so you got new construction, and we're very disciplined on what we buy. Most companies, hey, I'm doing garage doors, I got an opportunity to install fireplaces, and now I'm doing Home Depot, and then I started working with a builder, and then they just asked me to do a gate. And they do it all. And so we've been very, very disciplined, and that's how you get the highest multiple is retrofit. Garage doors at the highest amount of EBITDA. But I'll tell you guys, they know growth. And they come up with compensation programs, and we're not afraid to spend serious money to get the right leadership. And, you know, the biggest deal for me is my life is so much better. My mom's life is better. Bree's life, my fiance's, is better. I will say, I don't have kids. We're going to have kids in the future. I'm just going to be an old ass dad. But the deal is, I'm enjoying my dad's 72nd birthday and being able to give him everything he could ever want. Sending my mom to Italy. I'm enjoying taking really good care of my niece and nephews. They got trusts. And that money's going to work for them. And I wasn't sure, taking all the responsibility, going through COVID, going through AI, going against PE, if I was ready for that. So I think I got the greatest partners. And I know for a fact I couldn't scale the way I'm scaling. So you heard a small piece of a big pie is better than a big piece of a big pie or a small pie. So for me, it was the right decision. You know, I want to get to about 120 million of EBITDA, and then I see a clear path to 500 million of EBITDA. And at the multiples, if I could do that faster within the next 6 years, you know, that's billions and billions of dollars for my family. So that's the way I looked at it. And these guys, you know, if I don't know who to call, I call them, and they have access. They have access to everybody. They have access to buying stuff that you could never buy. They've got access to leadership teams you could never get. They've got access to technology. The right company. There's a lot of small PE companies out there that a couple guys got together with some money. They're not the same as the right guys that know what they're doing. And the PE is your partner of money, or the bank is, unless you're buying everything outright. And then it's going to stunt your growth like crazy. And when you're buying and building, you got this thing called integrations. Everybody comes to me and they say, I'm just going to buy companies. I'm like, man, you must be really good. You must have your SOPs down. Then you know how to hire. You've got one brand. You're buying the parts correctly. You must be a 23% EBITDA. You must be 30 to 50 million in your own market. They're like, no. I'm like, well, what are you going to do about integration? Switching over insurance, changing the culture, changing over the trucks, rewrapping the trucks, switching over the GMB, the LSA, doing a quality of earnings. Integrations is tough. We've got 100 pages of a checklist. And I'll tell you this, if I could go spend the money on marketing versus buying a company, I'll do that every day of the week to build it from the ground up. It just takes longer, as Ken said.
Excellent. Thank you, Tommy. Chris, we've heard them talk about outside capital as a way to grow. You clearly are up against, or not up against. In HVAC, there are a lot of well-funded HVAC roll-ups consolidations going on as well. Do you ever, how do you all allocate capital? Think about that, given how well-funded some of those other people are in your industry.
Listen, I think this game that we're all playing, right? Residential service, roofing, to pick your trade, it's won at the local level, right? And it's won by local brands, local leadership, executing really well. And I think about growth probably very similar to how private equity thinks about growth. And I think the path Tommy was going down a minute ago, I think is spot on. The first sort of prong of our growth strategy is organic growth, your base business. And I think so often people start chasing acquisitions because it's a sexy thing, it's the exciting thing. If your organic growth in your core business sucks, don't acquire businesses until you figure that out, right? I mean, or else you're just creating headaches and you're going to have two brands that suck and haven't figured it out instead of one, right? We didn't make our first acquisition until we were 80 or so million, and we had a 8-year CAGR over 30% inside of our core business before we even started entertaining acquisitions. The second way to grow that I think can be really, really effective, particularly in roofing. I was at an event, private equity event in New York 3 weeks ago, and Jane Margle in there from Vertex, right? But one of the biggest roofing roll-ups today. She said they're doing 12 greenfields concurrently in roofing, and that the ability to execute greenfields in roofing is completely different than the challenge associated with doing that in HVAC, plumbing, and electrical. And why? I think the reality is in a lot of markets, it's a sales and marketing game, and then you're curating a network of high-quality independent contractors. So your ability to put up a shingle and execute and grow in new markets is different, especially if you already have a lot of the shared resources that exist in place. So second category of growth, I would say, is taking your existing service lines to new markets, or inside of your existing markets, what are ways you can grow to serve your existing customers more deeply? You're doing roofs, you're doing gutters, you're doing siding. How about windows, right? You're doing HVAC. How about plumbing? How about electrical? And then the third bucket, I think after you've figured out how to do those first two and do them well, I think that's where some of the greatest value can be created. Then start looking at acquisitions. But I think folks go from core business not performing well straight to acquisitions, and I think that's a recipe for not a good outcome.
And let me just add something. If you could buy a company, and these are the best, they've been around 40 years, the guy's 79 years old, his phone's ringing off the hook, his guys don't know anything about sales, and he built something in the community, I would say a bolt-on in your current market, I would say yes to that, because there's no marketing. First thing I look at is how long have you been in business and how much are you paying for marketing, and there's a lot of companies spending zero. That's a gold mine, I will say that.
Excellent. Tommy and Chris, you both talked about organic growth, the key pillar of what you guys are doing. Look, growing a business organically, a lot of it relies on getting the right people, motivating them, incenting them. Can you talk about, we'll go down the line again, can you talk about how the ownership structure, partnership model you may have has enabled you to recruit, retain, and send some of the top talents you can actually execute some of these strategies that you're talking about?
Well, when you have a place for people to stay and grow, that want to stay there and grow. If you're just a one little location operation and you're hiring a sales rep and they're always going to be a sales rep, the sales manager is entrenched and there's no way that there's a vertical or an upward movement. you're going to have a hard time finding the best talent. If you're constantly acquiring and growing and looking for new operations managers and sales managers and general managers of locations and directors and that kind of stuff, well, then you have a career path that's not just a job. And that's really easy to recruit people. Plus, once you get to a certain size, now you have plenty of money to pay them what they're worth. And that makes it a little easier to recruit as well.
Excellent. Tommy?
Yeah, so I'll tell you guys the secret 3 letters that changed my life before I sold day one to the PE partner is EIP, Equity Incentive Programs. What happens is whatever your business is worth today at a fair market value of the multiple, that's the baseline. I put a $50 million value on my business. That was super low. I probably could have done 100 pretty easily. When I gave EIP to 20 people, the business went from 12 million to 27.5 million in 19 months because they had an owner next to their name. I got a really strong, now it's called profit units. It's another word for equity incentive programs. So I bring it all the way down to the technician level. I got 40 guys that did 1.3 million last year each. Now they get a chunk of equity. They're not going to leave. No one other garage door company I know is giving equity that should be equal to a few $100,000 every year they make it. So some of these guys are going to walk away with $1 million. Some of them did it 4 years. And it's even going to be better on the next deal. So I protect, they call them golden handcuffs, but I don't think you don't need handcuffs for my people. Like I've got a close relationship with them. We take them on a great trip. We went to Mexico. We have fun. So that's the greatest way. And everybody on my team there's no such thing as tenure. It's meritocracy. You get to make more money the day you start than anybody with tenure. I don't really care. I'll give you a nice birthday cake for your 10-year anniversary, but it's earned just like my business is earned. I'm on performance pay. Why shouldn't everybody else? You're allowed to make unbelievable money. I've got technicians making $350,000, which is great for garage doors. In the HVAC world, I know there's a lot of guys making 800,000. But the deal is like, what do you care if somebody makes 800,000? Let me ask you guys, would you trade 800,000 pay for $1 million EBITDA performer? $1 million at EBITDA. You're getting a multiple of that. If they're making 800,000, they better be bringing in $1 million of EBITDA. So like, you just got to do the math. And I feel like there's not enough math thought about in a lot of these industries. By the way, roofing is by far the best industry out there right now. That's why it's getting attacked. It's got a huge Irish ticket and it's the Wild West, and there's take this with a grain of salt, there's not a lot of great operators. I went kind of study HVAC for 5 years. I went to every $100 million company. I learned service agreements, learned how to finance, learned how to build homegrown techs, learned how to brand correctly, learned all the things that they know. And then I had to get 100 companies in the garage door freedom to train them. Otherwise, we were going to be too high of a price. So we had to change the industry. And a lot of people hate us. They're like, but these companies that hate us, they like to pay their guys $50,000 a year, keep them in the projects. They like to make sure they can't raise their family. They like to make sure they drive used trucks that break down all the time. And they like to complain. Never join a Facebook group with workers because they all complain and they just lie to themselves. Because you got to charge for profit and you got to have nice things and you got to take your people to restaurants and take them on trips and keep the air conditioning low in the summer and the heat on high in the winter. And every one of my guys drives new trucks. They have $6,000 of tools that we give them. And they're allowed to make great money. And anybody that they said, how do you sleep at night charging what you charge? I said, how do you sleep at night knowing you're giving a great deal to your clients so you can shit all over your employees? So we paid them what they're worth.
That's awesome. Hey, Tommy, I'd like to point out, so you mentioned you put that EIP plan in before
before we did it.
Okay, that's impressive. And Chris, talk about some of the things you've done to instate and recruit and retain the best talent out there.
Well, I'll react first. I love that Tommy did that down to the technician level. That's kind of been a filter where we haven't rolled our long-term incentive down to our frontline team members, but got my gears turning. Interesting idea. I'll answer this in sort of 2 ways. One is our senior executives, and then 2 is everybody else. And I'll start with the everybody else bucket. At the end of the day, to attract the best people, right? But we are a premium service provider in the markets we serve. Our product is our people, and if we need a premium product to fulfill those commitments to customers, which means I need to attract the best people. And baseline table stakes means you got to pay them the best, and you got to have great benefits. Now, what I will say is that means different things in different markets, right? So our compensation philosophy is that we want to be top decile, but we want to be top decile in every market. That means something different in Nashville than it means in Denver, than it means in St. Louis. And so we have to make sure we understand pay dynamics in those markets and that we are delivering a top decile compensation and benefit package to folks. For senior executives, it's no different than really private equity operates. We have a long-term incentive program. We also call it we have units in our profit interest program. And we kind of have a phantom cap table. The only difference is our exit is not based on the next time we transact. After the vesting period, we just have an open put option where they can sell at a predefined multiple that's inside of the plan documents and how it's executed. And then from our end, we just have to make sure from a liquidity management perspective, we're thinking about minority partner redemptions, long-term incentive redemptions, acquisitions and debt service, right? Capital expenditures and growth capital needed to support the business. And those are just all different variables that we have to understand how they fit together at any point in time. And it's part of the reason we generally operate with very low leverage. Because we don't want to get out over our skis with the commitments we're making to our team.
Two things you can do. One, you can do it now with a ghost share option, which doesn't trigger a tax liability, or you can do a share option once you've been acquired by PE. Most PE firms are going to want to put something like that in place. It's pretty standard.
Yeah, well, listen, if you did an IPO, you went public, every single C-suite is going to get stock options. There's not a private equity company on the planet that doesn't give profit units to the senior leadership team and a lot of VP all the way down to the director. So no one ever told us this. We're kind of like these blue collar guys. When you learn what they know and all of a sudden you could build a team with a stake in the outcome, it changes everything. It changes the whole dynamic of the business. If all these billionaires are doing it and the best traded Elon Musk, even though that name's controversial right now, and Jeff Bezos, if they're doing these things, it works. No one ever just pulled us aside and said this was working for public trading. This is what private equity is doing. And when you learn these little financial tools, everything changes because they work when you're not there. I'm here in Dallas. The company's going to settle. It's going to do, $1.3 million today. We don't skip a beat. You're not self-policing anymore. The people are self-policing. They're making sure every single thing's getting done. And it just changes your life. I got so much of my life back because I hired the right people. And they work just as hard, but they don't work harder than me, and I don't work harder than them. They work smarter. They're better than me at their key role. And I don't work, nobody clocks in or out at my leadership team or director level. They can work from home every day of the week. And I know all their shit's getting done. I got checks and balances, but they want to. And if they work 20 hours a week, I'm okay with that. If they want to work 60 to get their goal, I'm okay with that. I don't keep track. The butts and seats are what I used to care about before I had these programs.
Excellent. Thanks, guys. It sounds like you guys, all three, did a really nice job of bringing the same ownership mindset that people think only the owner has and feels to a lot of people in the organization to make better decisions throughout the time. So let's switch gears a little bit. One of the things I hear from owners a lot, we talked about like growth, opportunity, exits, things like that. One of the things I hear from owners a lot is about personal liability and risk they may feel as the primary owner of the business. Can you all talk about how that changes based on the ownership structure you have or going through a transaction, finding a partner, how that changes, the personal financial risk you may have with the business?
Yeah. So in 2004, 2005, I had made my retirement savings. 2008 to 2010, I lost it all just from stupid business decisions and trying to grow faster than what I could handle in a market that wasn't going to support it. And then I was able to get it all back and was looking for the next thing, but I was going to have to risk it in order to take over the market that I want to take over, the state of Florida. And I knew it was going to take 5 locations, and I didn't want to use my own retirement money to do that. So I went out to private equity and did it with their money. And when you sell that and you no longer are my majority shareholder, you no longer have personal guarantees and everything else that's tied to it, the risk is gone. You're an employee at that point. The only risk that I have is private equity screwing up and the 24% that I rolled basically being pissed away. But they're on track. I might make as much money on my 24% share sales I did on the original 76. So, there's just how you play it. And I like not having the risk. I sleep very, very well at night, and I love where my life is now.
Excellent. Here, well, Chris, we'll go to you next as Tommy spoke before Ken.
Yeah, listen, where we are today is very different than where we were in 2016, right? Just in terms of even accessing credit, I needed credit to be able to grow and acquire when I entered this business. And the only way I was going to get it is if I let a bank put their arms all the way around me and everything I own, right? With unlimited personal guarantees for my house, my retirement accounts, you name it. We've worked really hard today to get to a point where we've completely removed all cross-collateralization, all cross-defaulting, our operating companies over here. And then the reality in our world is We're blessed to be in a working capital negative business, meaning we get deposits in advance and cash upon completion, right? And we've got last year 54.5% gross margins, this year 56. And so these are great cash generating businesses, and it's allowed us to diversify our balance sheet while remaining committed to private ownership. And the acquisitions we've done today, we've been able to generate sufficient cash flow to have our net debt at zero, right? So managing risk matters, because the reality is this business today still is my single greatest asset, and I don't have a financial partner that's standing behind me to backstop it. If something goes wrong, it's yours truly, right? And so we're just really thoughtful around how we're placing bets. I still just have this stewardship mindset around our resources, and I'm just very, I scrutinize and put a lot of rigor into how we're thinking about capital allocation and where we're placing our bets as a business.
Excellent. Tommy, talk to you about the kind of risk and personal liability.
Yeah, it was a good day when I got the money. I mean, and this, like, I had a Goldman bank account. I thought it was like Monopoly money. I'm like, this can't be real. Like, if this just happened. And the guy at Goldman Sachs said, I said, there's no way I could spend all this money. He's like, trust me, you'll figure out how. And he's right. Made a lot of investments. But, I'll tell you, people always forget when they take chips off the table. Making money and keeping money are two completely different things. But when you use compound interest, Einstein said it the best, the most powerful thing in the universe is compound interest. And that money is making money. So a lot of people, Ken's sitting here going, I might get a huge check. Wait, maybe I wish I didn't sell. He's not saying that. But you got to remember, if you're able to get 12%, 50% IRR on that money, you got a huge chunk of money making you money, living your dreams, changing your parents' life, changing your kids' life, changing whoever your immediate family is. So that's really one of the best things about it. And I'll just say, like, on this next deal, I'll probably end up rolling a lot more than 47%. So I roll 47% on the next turn. I might roll 80 of that 47. Because if you set it up right, when you get the kind of money we're talking about, a great lender like Goldman or Morgan Stanley will loan you 40% against that in private stock. But you're double leveraging that way. You're getting it at 6%. But my uncle told me this, when you have a lot of money, deals find you. Things find you. You got to contain your ADHD and not do too many things, and put stuff in protective and bonds and have a well-diversified account. But if you do it right, you're going to be making a lot of money and you're going to be having a lot of fun. And that's what I say is, like, man, I had nightmares at night just pulling my hair out. COVID happened and I'm like, I might be going out to run jobs again, even though I had 120 technicians at the time. And I'm not the type of guy that pays off my house, because I think that's the dumbest thing in the world when you could get a loan at 3 to 6%. If you make 12% IRR, you're literally making, it just doesn't make sense. But Dave Ramsey shit is not for the business owners in the room. It's for the average American. But if you use leverage correctly, it can make you a lot more money.
Excellent. Thank you, guys. Well, let's even pivot one more time. We've got about 10 minutes left. And a lot of what we talked about so far is professional growth, business growth. Let's pivot a little bit to the personal side of things. How have the ownership decisions you've made, and Tommy alluded to this in a couple of his answers already, so I know this is important to him. How have those decisions you made, who to partner with, ownership decisions, affected those key relationships in your life? Family, friends, how you spend your time, things like that.
Well, I'm retired now, so I've got all kinds of time in the world. I travel internationally half the year, and you don't have to worry about cost. You just go. Where do you want to go? It's the best everywhere we go. It's awesome to live that life. And then the other half of the year, I'm doing stuff like this where I'm helping contractors understand how I did it and helping them do it too. So it's very, very, very rewarding. How it changed is you now are creating generational wealth, and now it's about protecting that generational wealth. So everything from the umbrellas, life insurance policies, the overage policies, your offshore bank accounts, your offshore trusts, everything going in trusts, how you split it up. It's all about tax. Tax is the biggest bill you will ever pay in your entire life, period. Every one of us will pay more in tax than anything else, anyone I know. So how can we minimize that? Because you know what they're doing. They're just sending it to Washington, D.C. and throwing it on fire. So might as well not send as much as possible. And that, like Tommy was saying, the eighth wonder of the world by Einstein, money doubles every 72 months. So how do you make the most out of that? And how do you protect it? And then for me, the most important part was, how can I not let it change me and who I was? How do you keep that humility? How are you okay sitting in economy class when you're used to flying first class everywhere? That kind of stuff. How am I okay flying commercially when I'm used to flying my own plane? right? That's a different mindset. And for a personal journey, I was ready for it because in the last 3 years of my career, everything was acquiring a company, rolling them into our system. I'm flying myself there. I'm bringing team members. So I'm filing flight plans, looking at weather, planning for meetings, doing debriefs with the laptop on my lap while I got the autopilot on and flying into level 3 thunderstorms that are sending me practically upside down on the plane, right? It's just really dangerous. And those 3 years really weighed on me. And I am absolutely loving not having those headaches these days. I was able to take about 2 or 3 years it took me to do the will, write the letters, and prepare for if I'm no longer here. And it's very liberating and very comfortable today.
Excellent. Chris, we'll go to you next with how it's affected kind of personal goals, relationships, people in your life.
Yeah, a couple of thoughts. So when I left the Marine Corps, my wife and I didn't have any money. She took all my deployment money for Afghanistan, paid off for student loans. My dad gave me a seller note, right? So this could stay a family business and we could pay him back over time. And I can tell you early on in the journey, like the temptation was that you hear about the sort of FOMO, everybody's selling. And when I didn't have anything, like that sounded really appealing. But here's the reality today, right? That whether I sold my business, I got a pile of cash, or whether I have 25 million of EBITDA, my lifestyle wouldn't change. And we've reached that point in time where I'm deriving the greatest fulfillment and satisfaction in my life right now. It's not about the pile of money. It's about significance and building something of significance that's impactful to a lot of people, to my family. I mean, listen, I'm 37 years old. You pop a couple $100 million in my bank account. I would be bored if I wasn't engaged the way I am today in my business, and I'm having a ton of fun doing it. And right now, I like the freedom that comes with our ability to still hold the keys to our business, right? And so there's nothing I can't do today. For me, where I spend my time, and I joke with these, I got a farm and I got cows. I just lost one this morning. I was hunting a baby cow that ran out before I came here. But for me, I'm happy. I got young kids. I'm doing everything I want to do. I want to show them a good example, which is me working hard, right? And doing that even when you don't have to, right? And I will say building a team has been great because the hat I wore at $9 million in 2016, right? You're like many of you, you're wearing the whatever the fuck it takes hat, right? You're going to do whatever you need to do to make sure the business is moving forward. And I did all those things, right? Today, I had a guy come in off our board after a couple years on our board to be our president, right? In our business, took a big part of my span of care. I've got him and our CFO today, but he's better than me in that seat, right? And that changes how sort of the immediate demands on my time. Still super engaged in the business, but gives me a little bit more freedom, which I value, especially with the 3 young kids that I have today. So I'm really happy with where I'm at. But again, it's a really unique situation. There's not a right or wrong answer.
Excellent. And Tommy, I know you mentioned it a little bit, but talk about the personal goals and how the decisions you've made have affected kind of the important people in your life.
Yeah, I mean, I still wear cheap clothes. Everybody will tell you that. I don't dress any better for sure. I would say that what I really tend to think about, this will be the last time I'm a CEO of any other company. I like to follow Richard Branson and find out how to build companies from the top down now. When you're struggling, you don't have money, you take every hat in the business, then you figure it out. Then you just learn to hire teams. Richard Branson probably works 3 hours a week, and he's doing amazing, and it makes people fly to him. So I get consulted, and I pay hundreds and hundreds and hundreds of thousands of dollars a year to get consulted by Dan Martell. He wrote one of the best books you'll ever read called Buy Back Your Time. And I said, Dan, I'm a very humble guy. I can't get a driver. He goes, well, how often are you driving a week? I said, 12 hours. He goes, you could get 12 hours of your time and be touching points with managers and employees, telling them how much you love and all these other things. And he says, tell me, are you a good cook? And I go, yeah, Chef Boyardee is in the fridge. He goes, listen, hire a chef. And he got me to look out of this different lens. And I got to tell you, we're not spoiled. Maybe a little bit now, but I do like the nice things in life. We just went to Disney World. We cut all the lines with the VIP service with my niece and nephews. And I want this for everybody that I work with. They're my coworkers. And my goal, I'm never going to get out of the game. I still want to have some control. But also, I'm willing to submit to people that are better at these things. So it's out, finding the right people. And I enjoy, I'll end right here. Robert Durkovich, the Shark Tank, bought a G4, and all he wanted was a G6. Because you're hanging around that crowd, and it happens. And all he wanted was to be on his deathbed and say, I gave it everything I got. I tried as hard as I could at everything I did. And that's all I want is when the day comes is that I didn't say I just fell back. And by the way, I don't have kids yet. Things are going to change dramatically when I have kids. But that's where I'm at today.
I'll loan you one line for a weekend.
Yeah, I'll take them.
Excellent. We got a couple minutes left. How about we'll go down. How about you share one of the biggest kind of misconceptions of things people may not understand about one of the paths you've taken? It might be for their own planning purposes, something you didn't expect going into it. But one of the biggest misconceptions that you're kind of trying to press on business owners you talk to about what matters for going down that path.
I will say you will exit your business in some way, form, or fashion. 92% of home improvement businesses are simply closed because people decide to retire and no longer can do the job. They get sick or they get injured. And that is a reality. So be in a position to always be ready to sell that company. And the irony is what you need to do to put it in a position to always be ready to sell is also going to make you more profitable in an organization that runs more smoothly, less headaches, and so forth. The other thing I'm just going to throw in there is there's a big difference in payout whether you're a platform company or an add-on. So if you develop systems, processes, and become the company that private equity wants to acquire, because they're going to use you as their gold standard. Think about the McDonald's operating procedures. They will pay you 3 times what we go and we pay for add-ons. Add-on is just a company that doesn't have all that together, but we're going to throw underneath a platform and we're going to triple our money the day we close. So be that platform, don't be the add-on.
I would just say, not all private equity is created equal. I was at this event recently, and folks were talking about up until 2022, 2023, everybody was winning. This game was easy in the HVAC, plumbing, electrical world, right? Up and to the right, the COVID acceleration, and all this sort of wind at your back. Today, we now have what they call like a bimodal distribution. There are a group of winners on one side, and there are a group of folks losing on the other side of this industry right now. And what I'm talking, this event, it was all private equity owned businesses. It was all private equity data on service type, winners and losers. And what does that tell me? Like, your partner freaking matters, and it's not just about the highest price, right? As Tommy said, Tommy has a legitimate, real partner that brings a lot of resources. There are a lot of shops out there. There's a lot of institutional capital, a lot of folks that fly under some banner of private equity, some flavor of it. And you need to really know who your partner is and what capabilities they're bringing to the table. Because in this market, it is harder. And in roofing, it is only going to get more competitive, more intense, more sophisticated capital, institutional capital is flowing into this space. Veritas is already $600 million today. Their goal is to be $2 billion next year, right? Across this country. And that's who we're all competing with, right? And so you need to make sure if you're going to bring on a partner, you're going to bring on a partner that's going to help you compete and win in that landscape.
Excellent. Tommy? Eric?
Yeah, well, I talk to entrepreneurs a dozen a day, and they all say, I want to get to 100 million. I go, why? They go, because that's what you did. And you got to this valuation, and I go, what are you at now? They're like 2 million. I'm like, why do you want my dreams? Well, have you ever reverse engineered what it would mean to take care of your mom, send your wife out, make sure your kids are set up, get you your first exit? I bought into 28 companies outside of A1. Every single one of them's got a 5-year plan or less. Once you exit it, you get the money. You could do things with that money. There's more opportunities that will find you. And it puts you on the map. So I would just say, reverse engineer your goals. Figure out what it's going to take for you to get the things that will take care of people around you and the people. I think it's selfish not to want to sell what he set up with his business. You can still get vested and take money out. But I would say, look, you're taking all these draws. You're putting your cars on it, your gym memberships, and going out to restaurants. What about the rest of the team? So I think when you realize what you could do with the money and you get to an exit, and you're on the map now, everything changes for you. And just pick your number and don't live anybody else's dream.
Excellent. Guys, do we have time? The guys in charge. Time for one more question, or I know we're coming close on time.
Yeah, you rip one more.
Okay, let's do it. We'll kind of do a retrospective kind of look back on things. I mean, we've seen the journey you guys have been on, how it panned out. Can you think about one decision you would like get on or redo, or one thing you might have done different in your growth journey?
Never let
Why it might be a little different?
Never let your business go in the red more than 1 month before making immediate drastic changes.
It's a good one. Chris?
Not Mello, right? Just yeah, listen, there's a lot of them. I think one thing that I wish I would have done sooner is just when people use the word culture, right? It's not about the fucking ping pong tables and the free lunch. Like I wanted to create a culture that we have today, which is accountability, a culture around accountability, high performance, achieving our goals, that orientation just makes a big difference versus the feel good and everybody wins and we treat everybody nicely regardless of your contribution or your impact. So making that shift earlier in our journey would have been easier and saved me some churn instead of those years where we were working to change that culture.
Excellent. Tommy?
You know, if I had to restart today, I'd be in roofing or HVAC. I would have get to the highest possible ticket. I mean, it's less work. I got to do 20 times the work to get to one of these tickets. So I would tell you that I had to close 4 markets down in one day. I would tell you that I was overzealous trying to grow too fast and not focus. I thought if I planted enough seeds, I was going to grow quicker, but not picking the right people. Now we closed down 3 markets recently because we knew we couldn't get to $3 million with the same effort of Atlanta, Dallas, or Houston, or Orlando, right? So picking the right markets and knowing and doing market research and not just growing to like a farm town because you could take market share. Like there's a whole decision tree we go down. And it's not 1 or 2 things. It's a several dozen to pick a market. And we go after growth markets. We do a competitive analysis. We look at Google. We look at all this stuff. And we just don't go with our gut anymore. We don't go with our intuition. And everything changes when that happens. So I would say, look, don't be like I was too stubborn and say we could work it out. Know to cut your losses, make changes quick. I have a rule: if I fall below 10% of EBITDA, I stop growth. I stop growth immediately and I make cuts and I figure out what's going on. And that takes a true leader. You might think you're the best person and you're so nice and you want to take care of people. Great leaders fire people that are not performing. They take the relationship out of it. And you're taking the whole team down if you're doing negative because you got a best friend or somebody that's been loyal to you. You'll ruin the company. You'll bring it down for everybody. You'll go bankrupt.
Excellent, guys. Gadget, really appreciate the insight. Really enjoy it. Let's give you guys a round of applause.
Yeah, awesome.